The world's central banks are no longer moving together, and that split is starting to matter for currencies, borrowing costs, and capital flows across the global economy. For years, major central banks hiked rates in near unison to fight the sharpest inflation surge in decades. That coordinated push is over. Now, policymakers are charting separate courses because inflation is cooling at very different speeds depending on where you look. In parts of Europe and several emerging markets, inflation has fallen close enough to official targets that rate cuts have already begun or are being seriously discussed. In other economies, services prices and wage growth are keeping inflation sticky. Central banks in those countries are reluctant to ease policy too quickly, worried that cutting too soon could let price pressures reignite. The result is a patchwork of interest rate environments, some easing, some holding, that investors and businesses now have to navigate. That divergence has real consequences. When central banks move in different directions on rates, currencies tend to feel it first. Countries with higher rates typically attract more foreign investment in bonds and deposits, which can push their currencies higher. Countries cutting rates may see their currencies soften, and a weaker currency makes imports more expensive, which can feed back into the very inflation central banks are trying to control. The Federal Reserve sits at the center of all of this. US rates influence borrowing costs around the world, and many central banks have to weigh Fed policy when making their own decisions. If the Fed holds rates at elevated levels for an extended period, it becomes harder for other central banks to cut aggressively without risking unwanted currency weakness. That constraint is very much in play right now. For consumers, the effects are already showing up in practical ways. In economies where rates are falling, some relief on mortgage payments and car loans is beginning to come through. Where rates remain elevated, households are still feeling the squeeze, credit is tighter, and borrowing costs remain high. How long this divergence lasts depends on two things above all: whether global goods prices stay contained and whether service sector inflation, which has proven more persistent than most expected, continues to moderate. Central bankers have been clear that they want to see sustained progress on both fronts before committing to further easing. One or two good inflation prints are not enough. Upcoming rate decisions from central banks in Europe, the United Kingdom, and across Asia will offer the clearest read on how far this global policy split has to run. The practical takeaway: when central banks diverge, exchange rates move, and exchange rate moves affect everything from import prices to the return on foreign assets. That dynamic is worth tracking closely right now. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.